October 31, 2008. In the midst of the worst financial crisis in 80 years, someone publishes a 9-page document on a cryptography mailing list. The author goes by Satoshi Nakamoto. No one knows who they are. To this day, no one has found out. The document is titled Bitcoin, a peer-to-peer electronic cash system. Its proposal is simple and radical at once: a type of money that needs no banks, needs no governments, and needs no trust in any institution. Only mathematics. 17 years later, Bitcoin is worth hundreds of billions. There are more than 20,000 cryptocurrencies. Central banks in 134 countries are studying the launch of their own digital currencies. And the question remains open: are we looking at the future of money or at the biggest speculative bubble in history? In the previous episode, we explored the digital economy, platforms, data, the transformation of work. All of that was built on top of the existing financial infrastructure: credit cards, bank accounts, conventional transfers. Today we go a step further. Because the digital economy did not just change how we buy and sell. It also made possible something that seemed like science fiction: money that exists without banks. To understand Bitcoin, you first need to understand the problem it tries to solve. When you send money to someone by bank transfer, you are not actually moving money. You are asking your bank to change a number in its database and tell the recipient's bank to change another number in theirs. The transaction depends entirely on those banks being honest, competent, and open for business. That works fairly well most of the time. But it has real problems. International transfers can take days and cost a significant percentage of the amount, especially for small sums. This is devastating for remittances, the money migrants send home to their families. A Latin American worker in Spain who sends €300 to their family can lose between €15 and €30 in fees. Furthermore, 1.7 billion people worldwide do not have a bank account. Not because they do not want one, but because they lack access. They live in rural areas, do not have sufficient documentation, or banking costs are prohibitive for their incomes. And then there is the trust problem. The financial crises of 2008 proved that banks could be irresponsible, that regulators could fail, and that governments could bail out the very institutions that caused the disaster with taxpayer money. Bitcoin proposes a solution to all of this. A system where transactions are verified by a decentralized network of computers, with no need for intermediaries. The technology that makes it possible is called blockchain. A blockchain is, in essence, a public and immutable ledger. Imagine a notebook where all transactions are recorded. Each page contains a group of transactions and a seal connecting it to the previous page. That seal is a mathematical code that depends on the page's content and the seal of the preceding page. If anyone tries to modify a past transaction, the seal changes, and the entire subsequent chain stops matching. Forgery becomes instantly apparent. That notebook is not kept by a bank or a government. It is held by thousands of computers simultaneously. To add a new page, the computers compete to solve a complex mathematical problem. The first one to solve it proposes the new page, the others verify it, and if it is correct, it is added to the chain. The process is called mining, and it consumes energy. A lot of energy. The result is a record of transactions that nobody controls but everyone can verify. Transparent, decentralized, and, so far, not successfully hacked. Bitcoin was born with ambitious promises. Censorship-resistant money. Transactions without intermediaries. A financial system open to anyone with an internet connection. Some of those promises have been partially fulfilled. Remittances in Bitcoin and other cryptocurrencies can be faster and cheaper than traditional bank transfers, especially along certain corridors. In countries with unstable currencies or strict capital controls, cryptocurrencies have provided an escape route for savings that would otherwise evaporate. But the problems are equally real. Volatility is extreme. Bitcoin has lost more than half its value within months, multiple times. That makes it useless as a currency in any practical sense. Nobody wants to be paid in something that could be worth half as much next week. Energy consumption is enormous. Bitcoin mining annually consumes an amount of electricity comparable to that of some medium-sized countries. Defenders point out that an increasing share of renewable energy is being used. Critics respond that renewable energy could be used for other things. And then there are the frauds. 2022 was the year the trust in cryptocurrencies took its worst hits. In May, Terra and Luna, an algorithmic stablecoin and its companion token, collapsed in 3 days, destroying $40 billion in value. In November, FTX, one of the largest cryptocurrency exchanges, filed for bankruptcy. Its founder, Sam Bankman-Fried, was convicted of fraud. Investors lost billions. The irony is eloquent. A system designed to eliminate the need to trust intermediaries ended up requiring people to trust new intermediaries, less regulated and, in some cases, openly fraudulent. In response to Bitcoin's volatility, stablecoins emerged, cryptocurrencies designed to maintain a stable value, generally pegged to the dollar. The idea is simple: for every token issued, there is a real dollar held in reserve. Or so they promise. In practice, the transparency of those reserves varies enormously. Tether, the world's largest stablecoin, has been repeatedly questioned about the actual composition of its reserves. Stablecoins have become an important instrument, especially for international payments and as a gateway into the crypto ecosystem. But they pose a serious political problem. They are private currencies denominated in dollars that circulate outside the regulated banking system. Millions of people use digital dollars issued by companies that are not banks and are not subject to the same rules. For many governments, that is unacceptable. And that is where CBDCs come in, central bank digital currencies. A CBDC is, conceptually, the digital version of the bill in your pocket. Issued by the central bank, backed by the state, with the same legal status as cash. The difference from the money you already have in your bank account is subtle but important. The money in your account is a promise from your commercial bank. If the bank goes under, that promise can break, although deposit guarantee funds cover up to a certain limit. A CBDC would be a direct obligation of the central bank. As safe as a paper bill, but digital. China was the first major economy to launch a pilot. The digital yuan, or ECNY, had been in testing since 2020 in several cities. By June of 2024, total transaction volume had reached 7 trillion yuan across 17 regions. Although the program has encountered adoption difficulties that have led some observers to question its future. Europe is working on the digital euro. The United States has debated a digital dollar intensely, though the political stance has swung between support and rejection depending on the administration. CBDCs promise efficiency, financial inclusion, and the ability to implement monetary policies in new ways. But they also raise legitimate fears about privacy. If every transaction is recorded by the central bank, the government would have a level of visibility into its citizens' economic activity unprecedented in history. Behind all the technical jargon, the question about digital money is profoundly human. For a migrant worker who sends €100 to their family every month, the difference between an 8% commission and a 1% commission is food on the table. For a small business owner in a country with an unstable currency, having access to a dollar-pegged stablecoin can be the difference between keeping their savings or watching them evaporate. For a citizen under an authoritarian regime, a decentralized cryptocurrency may be the only way to get money out of the country. But for a person who lost their savings in the FTX collapse, or who invested in Terra believing it was safe, the promise of decentralization sounds like a mockery. Digital money is not inherently good or bad. It is a tool. And like every tool, its value depends on who uses it, how it is regulated, and whom it benefits. First idea: Bitcoin proposed solving real problems in the financial system, such as remittance fees, banking exclusion, and dependence on intermediaries. Blockchain makes verifiable transactions possible without a central authority. Second idea: cryptocurrencies have also generated real problems. Extreme volatility, massive energy consumption, and spectacular frauds like Terra/Luna and FTX demonstrate that eliminating intermediaries does not eliminate risk. Third idea: central banks are responding with their own digital currencies, CBDCs. They promise efficiency and inclusion, but raise serious questions about privacy and state control. Digital money changes how we pay. But there is a much larger disruption on the horizon that affects something even more fundamental: how we work. Machines are learning to do things only humans could do. And the implications go far beyond Silicon Valley. Next time, robots, artificial intelligence, and the future of work.